Hello, everyone. I'm Sharon Garcia, Marketing Manager here at Mazars in the U.S., and I'd like to thank you for attending our webinar. Today, we continue with the third session of our REITs webinar series, Special REIT Structures and Looking Ahead, which will be led by Craig Stern, Donald Lease, and Bonnie Zukoff. Before we begin, I'd like to review a few housekeeping items. First, we encourage you to ask questions. To do so, please send them to us using the Q&A box on the lower left-hand side of your screen. We will try to answer all of your questions during the webinar, but if a fuller answer is needed or if we run out of time, your question will be answered after the webinar via email. Second, to earn the 1 CPE credit during today's webinar, you must listen to at least 50 minutes of the presentation and answer at least 3 polling questions. The polling questions are a series of questions meant to confirm that you are actively attending this webinar. Please note that you must be logged in individually to receive credit for today's webinar. If you are attending as a group, only the individual who is logged in will receive credit. If you've completed the requirements, your certificate will be available for download at the end of the webinar. Instructions on how to download your certificate will be displayed on the screen at the end of the presentation, so please stay on the line. Lastly, you can download a copy of today's presentation from the green Resources button at the bottom of your screen. Here, you will also find our webinar Frequently Asked Questions, a document which offers some basic troubleshooting information and other useful tips. Again, this can be found under the green Resources button at the bottom of your screen. Now, thank you once again for joining, and I'll hand it over to Howard Landsberg, a partner here at Mazars. Howard?
Thank you, Sean. Good day to you all. I'm Howard Landsberg, and I lead the real estate practice in Mazars in the United States. I'd like to welcome you to the third installment of the Mazars REIT webinar series, Special REIT Structures and Looking Ahead. Mazars is a leading international audit, tax, and advisory firm. We operate as a united partnership, as one integrated team who leverages our expertise, scale, and cultural understanding to deliver exceptional and tailored services around the globe. Mazars has more than 24,000 professionals operating in over 90 countries and territories. Throughout this webinar series, you'll learn more about the Mazars REIT practice, our experts, and technical REIT subjects. Today's webinar, REIT Structures and Looking Ahead, will be led by Craig Stern, Don Zeef, and Bonnie Zukoff. Craig has more than 30 years of experience in the real estate and investment industries with a focus on transaction services. He has worked on over 100 mergers, acquisitions, dispositions, joint ventures, inbound investments, and spin-offs with deal sizes ranging from $1 million to $6 billion. Don also has more than 30 years of experience in the real estate industry and focusing on REITs. He is the co-author of the Real Estate Investment Trust Handbook, published by Thomson Reuters. Bonnie has more than 10 years of experience in the real estate industry, specializing in REITs. Thank you, and here it is off to Craig to start us off.
Thank you, Howard. Today's agenda will be as follows. We're going to cover some very interesting topics, I think. Uproot, Downreach, Baby REIT, the RDA Lease structure, infrastructure REITs, and we'll spend a few minutes looking forward to the various proposed legislation that is out there. First topic is going to be Uproot. As participants of the prior webinars know, I like to start each webinar with the question. Today's first question is, why do Uproots exist? REITs, as we learned in our first webinar, were created by the 1960s Tax Act. From 1960 through 1991, all REITs were in the traditional REIT structure, which is public investors putting money into a REIT and the REIT then going out and buying property. This started to change because of the 1986 Tax Act. The 1986 Tax Act created both at-risk rules and passive activity loss limitations on real estate, causing a decline in real estate investment and real estate values. The combination of the two caused traditional real estate lenders to reduce lending to real estate. Real estate owners and developers had little to no access to refinance their maturing loans or to make capital improvements. The two choices were often to go bankrupt or to raise capital in the public market by becoming a REIT. Back then, the threshold to become a public REIT was approximately $100 million, far different than it is today. However, once the real estate owner met the $100 million threshold, they discovered a tax problem. Section 351E would treat their contribution of property to a REIT as taxable, and Section 357C would trigger income to the extent debt exceeded the property's tax basis, which was often the situation. The solution, many claiming to be the author thereof, was to create an umbrella partnership under the REIT, what we now know as the Uproot structure. Taubman in 1992 was the first REIT to use the Uproot structure. As the picture shows, the Uproot structure dealt with the tax issues of contributing to the REIT by contributing the property to the operating partnership and having the REIT contribute cash to the operating partnership instead of the owners of the property contributing the property directly to the REIT. So there you see our common structure of REIT, which is the general partner of the operating partnership, and the operating partnership owning all the real estate assets, both contributed assets as well as assets that were purchased. So in text, sort of what is the REIT structure, the Uproot structure? Structured properly, the contribution of the property by the contributor to the operating partnership of the REIT and the Uproot structure in exchange for partnership interests is generally tax deferred under Section 721 as opposed to having been taxable if it had contributed directly to the REIT. In an Uproot transaction under Section 723, the operating partnership acquires the contributed property with a carryover basis, so the contributor's initial tax basis and the operating partnership interests received in the transaction adjusted for debt equals the tax basis of the contributed property under Section 72. Depreciation and built-in gains in the property at the time of contribution will generally be specially allocated with respect to the contributor under Section 704C. The contribution is generally effected pursuant to a contribution agreement containing terms similar to other real estate purchase and sales agreements. Each operating partnership unit received by the contributor is the economic equivalent of one share of REIT stock, and this parity includes the OP units and the REIT shares receiving identical distributions. The operating partnership units generally include redemption rights under the partnership agreement, which typically commence no sooner than 24 months following the closing to mitigate the risk of disguised sales. The redemption rights generally, if exercised, are at the option of the general partner and can be satisfied either by cash or with the exchange on a one-to-one basis of OP units for REIT shares. That exchange is a taxable exchange. The provision is necessary to avoid BOO treatment on the property contribution. In order to protect against taxation of the operating partnership's sale of the contributed property, the contributor and the operating partnership enter into a tax protection agreement. The tax protection agreement typically requires the operating partnership to make a tax indemnity payment to the contributor if the property is sold in a taxable event within the tax protection period, which is a negotiated term, typically between 5 and 10 years, or sometimes after the death of the contributor. As you know, in our experience, the operating partnership almost never makes a tax indemnity payment, and if it wants to dispose of the contributed property within the tax protection period, it will enter into a tax-free like-kind exchange so as to avoid triggering the tax indemnity responsibility. What are the advantages of the Uproot structure? As we said earlier, it avoids Section 351E and 721B on contribution of property. It can be a substitute for like-kind exchanges in that a contributor is contributing the property and in effect is receiving a partial interest in all the other properties that are within the operating partnership, which will be very handy if like-kind exchanges are reduced in availability or eliminated. It provides liquidity due to the redemption right for cash or publicly traded REIT stock. It is generally tax-free under Section 721. Distributions are generally tax-free under Section 731, including debt finance distributions. You can have a negative basis because of the allocation of liabilities. It has special Section 163J rules to mitigate the limitations under Section 163J. You receive the same distribution as a REIT shareholder, and you get the ability to get special allocations under Tier 3 of non-recourse liabilities. So what are the disadvantages? Some of the disadvantages are potential PTP characterization if the 90% qualifying income test is not met. Well, this is very unlikely since the items of income that qualify for PTP exception also are the same income items that qualify for REIT qualifications. The exchange of OP units into REIT stock is taxable. 704C allocations of income apply, and gain will be allocated to the contributor after the expiration of the taxable protection agreement. There's potential 707 disguise sale if cash is received within 2 years. There's potential 704C1B and 737 if the contributed property is distributed or other property is received within 7 years. And there's potential Section 752 gain on the relief of liabilities. So what are the tax considerations on the contribution to an Uproot? So the first area are the allocations of liabilities under Section 752. So as we know, if a contributing partner contributes property and that property is subject to liabilities, and if the contributor's share of the liabilities is reduced, such reduction is treated as if it was a distribution of cash by the partnership to the partner under Section 731. Any cash distribution, actual or any deemed cash distribution resulting from the reduction in debt may be taxable to the extent that the distribution exceeds the partner's remaining tax basis in the operating partnership. In addition, it could result in a disguise sale under 707, and it can cause a recapture of at-risk allocations under Section 465. Second issue on the formation of an operating partnership is the disguised sale rules under Section 707. In general, the disguised sale rules are designed to capture transactions that are in substance actual sales, and it does that by creating a presumption that any contribution of property to a partnership followed by a distribution of cash or other property by the partnership to the contributor within 2 years will be treated as a disguised sale. However, there are certain very important exceptions to this rule, including reimbursement of pre-formation capital expenditures as well as debt finance distribution. So those exceptions are critical in being able to get cash distributions from the Uproot within the 2-year period without having it treated as a disguised sale. The third item is negative basis recapture under the Section 752 regulations. To avoid any reduction in the amount of liabilities that are allocated to the contributor under 752 regs, the tax protection agreement usually contains restrictions on the operating partnership's ability to repay or refinance the debt on the contributed property for a period of time that mirrors the tax protection agreement. So generally, that means that the tax protection agreement will prohibit the operating partnership from refinancing the property or specifically repaying the debt within the tax protection period when the contributed property has negative tax basis. In the rules prior to the 2016 non-recourse debt changes, it was typical for partners to guarantee some of the debt using bottom dollar guarantees to provide basis. Generally, this is no longer allowed after the 2016 regulations. However, the 2016 752 regulations will still allow allocations of liabilities with respect to vertical slice guarantees and guarantees that may be partially indemnified, but only to the extent of 10% or less. The third issue is the common issue with regards to contributions to partnership, which is that appreciated property will be subject to 704C, allocations of depreciation and gain and sale, meaning that there will be special allocations of depreciation against the contributor and to the other partners, and on the sale of the property, any remaining built-in gain will be allocated to the contributor. So we come to the first polling question, which Sean will ask.
Thank you, Craig. So the first polling question of the webinar is up on your screen, and it reads, do you plan to apply the credit earned in today's webinar towards your annual CPE requirement? Yes, no, or not applicable? Please make your selection now and be sure to click the submit button to get credit for your answer. Okay, we'll give it just a few more seconds. Be sure to click submit to get credit for your answer. Okay, let's take a look at the results. Okay, so 87.1% of the audience said yes. Great.
Thank you, Sean. So the next topic we're going to discuss is an alternative to the Uproot known as the Downreach, which will be evident from the following slide. The Downreach structure, the REIT contributes property to a joint venture, and the property owner contributes the property. So it is similar to an Upbring in that the REIT is putting in cash and the property owner is putting in property, and the entity that owns the property is a joint venture. The difference is that the REIT's existing properties all remains with the REIT, either directly or in an Uproot structure, but does not go into the joint venture with this particular property owner. So it has some similarities to an Uproot, but also is a different structure than an Uproot. Now, the Downreach structure is designed for a situation where a REIT just has not adopted the Uproot structure for a variety of reasons, and they want to acquire property on a tax-deferred basis. To do that, they still need a partnership structure because the contributor needs to avoid Section 351E by a direct contribution to the REIT, and therefore needs a partnership to contribute to, and hence the Downreach structure is used. Unlike the Uproot structure, where all the activities are performed at the operating partnership level, meaning all the properties are at the partnership level, the Downreach is just a joint venture between the REIT and the property owner. The property owner's asset is in the Downreach, and that is the only asset of the Downreach. It does not have any of the REIT's assets. In exchange for contributing the property to the Downreach partnership, the property owner typically receives a number of preferred units in the Downreach partnership, which is entitled to a distribution equal to the dividend rate on the REIT preferred shares. And they also receive a put right to receive REIT preferred shares or an equivalent cash payment based on the original value of the preferred shares. Because the only assets in the Downreach is the property contributed by the contributor, meanwhile the REIT has all of its properties, the Downreach partnership's performance does not at all mirror the performance of the REIT. If the Downreach structure is respected, generally there is no tax liability is triggered on the contribution under 721, and it's not until the units are redeemed or put to the REIT for cash or shares, or the property's partnership's assets are sold, will there be a taxable event. They're again similar to an Uproot. So let's walk through an example. There is an owner of real estate that contributes property subject to non-recourse debt to the REIT, and the REIT to the Downreach, and the REIT contributes cash to a single asset joint venture. The net value of the contributor's property for distribution and redemption purposes is deemed to be equal to equivalent value of REIT shares at the current market price. So, for example, if the property's net value is $100 million and the REIT shares are trading at $50, the contributor is treated as owning 2 million shares for purposes of distribution and redemption value. The Downreach Partnership Agreement, similar to the Uproot Partnership Agreement, provides that cash flow will be distributed to the contributor as a preferred return until it receives an amount equal to the quarterly dividend on the deemed shares. Thereafter, the REIT receives 100% of the cash flow. However, to the extent the Downreach Partnership, which only has the contributor's asset, has insufficient cash flow to pay the preferred return, which is often the case. Normally, the REIT's preferred rate is somewhat higher than the operating cash flow of a given property. The REIT is obligated to make a capital contribution to the Downreach to fund payment of the preferred. Except upon liquidation of the Downreach Partnership, cash from the sale of refinance of the property is distributing first to the contributor until it receives an amount equal to accrued and unpaid preferred return plus an amount equal to the preferred return. Any remaining cash will be distributed to the REIT. Profits from the operating of the Downreach Partnership will generally be first allocated to the contributor to match its preferred return, and thereafter 100% will go to the REIT. In addition, 2 years after the formation of the REIT, the contributor will have the right to contribute to exchange its partnership interest for REIT shares or at the REIT's option for a amount of cash equal to the value of the unit. So similar to an Uproot, after 2 years, to mitigate the risk of disguised sale, it may have a right to exchange its units. Similar to an Uproot, the contributor and the REIT will negotiate the 704C method to be used with regards to depreciation, and also negotiate a lockout agreement which will prohibit the Downreach Partnership from selling the property or reducing debt such that it will not trigger gain. What are the advantages of the Downreach structure? So, as we said earlier, the Downreach is intended to mirror an Uproot structure for a REIT that has not adopted the Uproot structure. So the intended benefit, both from the contributor and for the REIT, is to allow the contributor to receive units that, on a tax-free basis, that have liquidity through an exchange right, and that has value that is based on the agreement with the REIT. So the disadvantages of a Downreach from a structural point of view is that the Downreach is designed for one property. So if there are going to be future acquisitions, the Downreach structure is not designed for that. And especially for the REIT, because the REIT wants to keep the Downreach solely as a pure joint venture with that contributor, which means that it doesn't want to put additional properties into that Downreach structure. In addition, unlike an Uproot where there are lots of properties to finance, the Downreach structure only has the contributor's property, and therefore the ability to receive debt finance distributions are limited because there aren't other properties to leverage, unlike an Uproot structure. So what are the tax issues with the Downreach? The Downreach structure, unlike the Uproot structure, has not specifically been addressed by the Internal Revenue Service. And therefore, all the issues that were inherent in the Uproot structure, which have been dealt with by the IRS over the last 20 or 30 years, do not apply to the Downreach structure. So the Uproot structure has a ruling in the regulations that say that the Uproot structure does not create anti-abuse. The Downreach structure does not have similar protection. So the risks for the Downreach are for them, and you can read them at your leisure. But the four risks is that it's first, it can be treated as a disguised sale because of the general partner's guarantee of any funding shortfall. And there is a specific regulation of 707-4A4, example 2, which concludes that such an obligation creates a disguised sale. There is a risk that the Downreach Partnership will be treated as REIT stock because of the similarity in the economics between the REIT stock and the Uproot structure units. There is a risk that the put right will be treated as brute. And the fourth risk is that the partnership agreement allocations will not be respected because the economics of the transaction don't really mirror the property returns, but really mirror more the REIT income returns.
Hello?
So the comparison of the Uproot and the Downreach is the fundamental that the Downreach only has one property, one set of liabilities, and therefore all of its tax attributes are based on that one property, as opposed to an Uproot where tax attributes can be shared more generally among all of the properties. This brings us to the second polling question.
Thanks, Craig. So the second polling question of the webinar is up on your screen, and it reads, in an Downreach structure, all activities are performed through a joint venture between the REIT and the third-party property owner at the operating partnership level. Please make your selection now and be sure to click the Submit button to get credit for your answer. Okay, we'll give it just a couple more seconds. Be sure to click Submit. Okay, let's take a look at the results. So 59.4% said at the operating partnership level. How'd they do, Craig?
Well, the 59.4% is correct. So in Uproot, all of the activities and all the properties are at the operating partnership level. The Downreach structure is the joint venture between the REIT and the third-party property owner, where the property is only of the third-party property owner. Next, Don will talk about Baby REIT.
Thank you, Craig. Right, so I'm going to talk a little bit about Baby REITs and just exactly what are they. Simply put, it's a corporate subsidiary of another corporate entity. Typical subsidiary parent relationship, except in this case, both C Corps are REITs. The parent REIT generally owns 100% of a Baby REIT, but in certain situations, it can be less. Here's a typical structure of how a Baby REIT works. You have the parent REIT up top, a Baby REIT down below. This particular parent REIT has a TRS as well. The parent REIT owns 3 properties. The Baby REIT owns 1. And that allows special shareholders like tax-exempt shareholders and foreign shareholders to invest in only 1 property through the REIT structure instead of several. So what are the reasons for Baby REITs? So it allows a parent REIT to deal with a single asset, just as we saw. Tax-exempt entities like this structure because there's very little risk that dividend income will be unrelated business taxable income to them. Foreign entities like this because if they invest in a domestically controlled REIT, then gain on the sale of those shares is not subject to FERPTA tax. And a Baby REIT owning a single property that then liquidates can generally escape prohibited transaction characterization and subject to the 100% excise tax on a REIT for dealing with dealer property. So, is a Baby REIT subject to the same test as any other REIT? The answer is yes. Every single REIT, parent, baby, public, private, whatever, is subject to the exact same test and must pass them. The asset test, income test, distribution, ownership tests, and can be exempt from the prohibited transaction 100% test if they meet safe harbors. The issue with the Baby REIT is it can experience more issues in satisfying these requirements than its parent REIT. So, what about a Baby REIT? It's from the parent level. Does an investment in a Baby REIT pass the REIT test? And the answer is yes. Baby REIT stock, as opposed to other stock, is considered a real estate asset, so it's not a security and it passes the asset test. Dividend income from a REIT, as opposed to dividend income from another C Corp, is good income for the 75 to 95% income test. And as to the distribution test, which a Baby REIT is subject to, also, it frequently will distribute or declare consent dividend on consent stock. And we're going to go into exactly how this happens a little bit later. So the ownership tests are two of the tests that a Baby REIT sometimes has problems satisfying. The 5 or fewer test says that 5 or fewer individuals cannot own more than 50% of the value of a REIT during the last half of the taxable year. However, a Baby REIT frequently is owned 100% by a parent. In other words, it's 100% owned by another entity. Isn't this a problem? Well, REITs can, for this particular test, can look through any entity above it until they get to an individual. Here, the parent REIT, assume will satisfy the 5 or fewer test by having many shareholders, and if they satisfy that test because of the look-through rule, the Baby REIT will also. Let's talk about the 100 shareholder test. Once again, this applies to all REITs. Every single REIT must have at least 100 shareholders. So if you have a structure where you have a parent REIT and 3 Baby REITs, you will need 400 shareholders. Each REIT must have 100. There's no look-through for this purpose. So, but many shareholders in each REIT can be the same. It's viewed as a separate investment by a separate individual. Sometimes there'll be an offering of an investment in the parent REIT, which requires a mandatory investment in the Baby REITs as well for just this purpose. So if you remember from the chart, the Baby REIT was underneath the parent REIT, much like a TRS can be. The risk, as I said before, is that a Baby REIT has more problems in meeting the REIT test than a parent REIT. And if a Baby REIT loses its classification as a REIT, what a lot of practitioners do is file what's called a protective TRS election with their annual REIT return. And it will say on it, on Form 8875, which is the TRS election form, that it is being filed as a protective TRS election. One caveat is that the value of all TRSs owned by the REIT cannot exceed 20% of the REIT's gross assets. In addition, TRS dividends are good for the 95% gross income test, but not for the 75% gross income test. The last question is this procedure valid? It's never been tested. There are no private letter rulings on it. Practitioners believe it should work, but there's no 100% guarantee. What are the disadvantages to a Baby REIT? Well, as we said, a foreign shareholder gets the benefit of being exempt from the FERPA tax only if it invests in a REIT that's domestically controlled, which means it and other foreign investors cannot own more than 50% of the value of the REIT. As to the prohibited transaction of 100% tax on dealer sales, if there's a liquidation of several Baby REITs, which each own single properties at the same time, it could cause the IRS to argue that the Baby REITs were mere agents of the REIT and property sales were made by the REIT and therefore possibly subject to the 100% prohibited transaction tax. There's also additional administration, additional state and federal tax returns, incorporation documents, bylaws, etc. And sometimes a Baby REIT can be a captive REIT, which we're going to discuss a little bit later on. Now, what if a parent REIT owns an LLC or a limited partnership and it would like to convert that into a REIT that's considered a Baby REIT? First of all, it can convert it, and there's no requirement for an LLC or a partnership to turn itself into an actual corporation under state law and file corporate charters, etc. It just must be treated as a corporation or a corporate entity for the tax law. One way it does this is to file an 1120 REIT return, which is the only way of electing REIT status. And if you can see on the bottom, I cited this reg, where if you file an 1120 REIT return for an LLC, it will be deemed an election to be treated as a corporation for REIT purposes. If a REIT's already, if an entity is already existing, by filing a Form 8832 and, quote, checking the box the date the REIT comes into existence can be specified. So the 100 shareholder issues, again, as I said, might be a problem. These are called accommodation shareholders, represent the fact that this rule is really not so much of an important rule anymore. It's really a formality. Generally, the 100 shareholders will be preferred, get preferred stock instead of the second class of common. Typically, they'll have $1,000 par value, a 10 to 12% coupon, be non-convertible and non-voting. However, a REIT has to strictly adhere to these preferences. In other words, preferred shareholders have to be paid for before common. And if other preferences in the corporate documents are not followed, the entire dividend distribution, both the common and preferred, can be disallowed. However, as a result of the PATH Act, preferential dividends are no longer an issue for publicly offered REITs. This generally doesn't affect baby REITs, which are mostly private REITs. One of the REIT requirements is that shares be transferable. They don't have to be freely transferable, but they must be transferable. The best practice is that there are no restrictions to be put on transferability, but from a business point of view, that may not be practical. One solution is to have transfer restrictions in a shareholders agreement among shareholders to which a REIT is not a party. And the transfer of shares can be with the consent of the non-transferring shareholders, and the consent can't be unreasonably withheld. Typically, there will be what's called an ownership limit in the REIT documents, which say that no shareholder can own more than 9.8% of the vote or value of the REIT. That comes from 9.8% times 5 is a little bit less than 50%, which therefore ensures that the 5 or fewer rule will be complied with. And if someone owns more than 9.8%, say 12, that extra 2.8% will be deemed to be an invalid transfer, many times deemed to be transferred to a charitable trust. Now, there are certain restrictions permitted. Restrictions can be put on transfers of REIT stock to comply with securities laws, to preserve REIT status, such as the 5 or fewer rule, and that you don't drop low shareholders, to keep domestically controlled REIT status, to protect against related party rents. There are rulings on all these issues. If there are restrictions on transfer of partnership interests among partners that own, where the partnership owns the REIT, they will generally be respected and not be a problem for REIT transferability. Now, it's important that the baby REIT respected as a separate entity, that it should enter into agreements on its own account, and it should have its own bank accounts and deposits made into that. As to distribution issues for the baby REIT, sometimes it'll have insufficient cash to distribute up to the parent, or cash distribution could be blocked by loan agreements. One way to get out of this is for a REIT to declare a cash and stock dividend, which qualifies for a dividends paid deduction and is dividend income to the shareholders. But if there are not many shareholders in a baby REIT, as typically there are not, this is generally impractical. As I mentioned before, baby REITs typically declare consent dividends, which is treated as if cash is distributed up to the parent REIT, and the parent REIT contributes stock back to the baby REIT and gets an increased basis in the shares. Only participating consent stock can consent to this, generally common stock. All the shareholders have to consent, and the consent dividends cannot be preferential. Now, some states it won't work, or such as California, they do not recognize consent dividends and do not allow a dividends paid deduction if there is a consent. There's some other uses of baby REITs, which I'm not going to go into too much of the detail. They can be used in the C Corp to a REIT conversion, and there's certain first-year requirements that there's a distribution of C Corp E&P, and the 1374 built-in gains tax be avoided. As for state tax, a REIT structure can eliminate income taxes at the property level. Some states also provide a dividends paid deduction qualifies to reduce or eliminate franchise taxes and even realty taxes. Some states classify a baby REIT as a captive REIT, which is generally defined as a REIT owned more than 50% by a C Corp, which is not a REIT. And in this case, a captive REIT would not be entitled to a dividends paid deduction. This can happen, it's always infrequent, if the parent REIT loses its status as a REIT, becomes a C Corp, owns more than 50% of the baby REIT. The dividends paid deduction would be denied. Also, there could be a difference in basis for state tax purposes versus federal if, for example, a state like California does not allow consent dividend. Oh, I see we have another polling question here. I'll turn it back over to Sean.
Thank you, Don. So the third polling question of the webinar is up on your screen, and it reads, a protective TRS election for Baby REIT is an annual filing, a one-time filing, indicated in quarterly REIT testing, no filing is necessary. Please make sure you click the submit button to get credit for your answer. We're going to give it just a couple more seconds. Be sure to click the submit button to get credit for your answer. Okay, let's take a look at the results. So 49.3% said a one-time filing, Don.
Yes, that is correct. It's a, I'm sorry, that's not correct. The correct answer is an annual filing. This must be filed annually with the REIT's annual return every year. So let me, I'm going to say a few words about RDA leases. Now, RDA stands for the REIT Investment Diversification and Empowerment Act of 2007, which was included in the Housing and Economic Recovery Act of 2008. A RDA lease, we're really talking about two industries here, the lodging industry and the healthcare industry. And what the RDA Act did was make the treatment of leases from TRSs to REITs for healthcare facilities the same as for lodging facilities, which was passed a few years earlier. So the most important benefit of a RDA lease is an exception from the related party rent rules. If you remember, if a REIT owns more than 10% of a tenant, that rent to the REIT is related party rent and is not good rent for REIT purposes. If there is a qualified lodging or healthcare facility, the RDA rules say that rent coming from a TRS tenant is good rent, and the related party rules are not a factor. One thing to remember with TRS, however, is that it cannot directly or indirectly operate or manage a lodging or healthcare facility the way it competes with this rule, as we'll see a little bit later, that the facility is operated on behalf of the TRS by an eligible independent contractor. The typical structure for a RDA lease is right here on the chart. You'll see a REIT owns a TRS. The REIT leases a lodging or healthcare facility to the TRS. The TRS then hires an eligible independent contractor to operate the facility. So what is a qualified lodging facility? It's a hotel, motel, other lodging establishment where more than one-half of the dwelling units are used on a transient basis and where no gambling activities are conducted. The operative word here is transient. It's not defined in the REIT rules, but it generally means a rental period less than 30 days in other areas of the code, which was specifically recognized in Private Letter Ruling 2008-428. You can see here that transient rules, for example, at a ski lodge, a freestanding restaurant, was looked as one overall lodging facility because average stay was much less than 30 days. On the other hand, an RV park is not a lodging facility, as it has paved open spaces for leases, while a lodging facility offers living accommodations within the building structure. And because of that, since it doesn't qualify as a lodging facility, a TRS can operate or manage an RV park. What's a qualified healthcare facility? You can see here there are many definitions of what type of property is here. Hospital, nursing facility, assisted living, continuity of care, qualified community group dining. there are many, many more rulings in this area of qualified healthcare facility than there are in the qualified lodging facility because of the many different types of living arrangements. And the most frequent issue is the proper treatment of independent living facilities, which are similar to multifamily residential apartments, although typically they offer various services such as in-group dining, things like that. The main issue that the IRS confronts when they're looking at a qualified healthcare property is, does it furnish more medical services than it does apartments? You can see from these two rulings that the IRS held that these facilities were not qualified healthcare facilities, as the services rendered, while some of them were health-related, were not enough to overcome the presumption that they were really like apartment living. There's some helpful rules in the RDA area. Now, as I said, the facility must be operated by an eligible independent contractor. An eligible independent contractor starts off with an independent contractor, which is someone who does not own more than 35% of the value of the REIT, and a person owning, if they owning 35% or more, the independent contractor do not own more than 35% of the REIT. The independent contractor cannot be an employee of the REIT. It must be adequately compensated and account pay any of its income to the REIT. Once you get past these requirements, you then go into what's required for an eligible independent contractor, which is the additional requirement that at the time of entering into a management contract with a qualified lodging or healthcare facility, it is already actively engaged in the trade or business of operating facilities such as this for any non-related person to the REIT or the TRS. And there's some very liberal rulings here. For example, the TRS can be a partner with the eligible independent contractor as long as the TRS has no ability to direct the operations or management. The TRS can sublease a property to a separate entity, which then engages an eligible independent contractor. There's even a ruling where a hotel management company qualified as an eligible independent contractor, even though wholly owned by the REIT's chairman, president, and CEO, the IRS looked to the facts that showed it was actively engaged in the trade or business of operating qualified lodging facilities. There are actually very helpful rules for an eligible independent contractor that go above and beyond what's required for an independent contractor. For example, the normal rule is that an independent contractor cannot bear the expense, the independent contractor must bear the expense of furnishing a non-customary service, whereas the TRS can bear all the expenses of the operating facility. In addition, the normal rule for an independent contractor is that the REIT cannot receive any income from it, whereas a TRS can receive the revenues from the operation, net of expenses, and the fees payable to the contractor. The ruling here at the bottom, the 2020-2902, was very important last year because it confirmed that this is an ownership issue where the related party rules are not applicable. The TRS was in an ownership structure where a downward pass-through entity owned qualified healthcare facility and employed individuals that actually worked at the facility. Because, generally a pass-through entity, a partner is viewed as engaging in the operations of that entity. The IRS, however, looked at the TRS as a separate entity here and held that because it did not operate or manage the facility through its, quote, employment of personnel at the properties, that it had no role in supervising individuals. It was performed by an independent contractor. It was not viewed as operating or managing the facility. Now note that since we're not dealing with a related party lease, there's no need for an eligible independent contractor, just an independent contractor. Now, it's important that where the TRS has a lease, once again, back into the related party rent rules, with the REIT, that the payments are not based on the net profits of the tenant. It's okay, however, it's based on the gross rent paid to the REIT by the TRS. The terms have to be fixed at the time of execution of the lease, and they can be renegotiated during the term, but they can't have the effect of basing the rent on income or profits. For example, if after the negotiation of the lease, the TRS performs better than expected, that lease really cannot be renegotiated. Any such action would be viewed as taking part in the net profits of the TRS. On the other hand, if there's an economic downturn and the TRS is in economic distress, the REIT can forgive some of the TRS lease obligations. It can lower some of the future rent. Because of the economic distress, this probably would not be viewed as engaging or taking a share of the TRS's profits. However, the REIT should be prepared to support the actions they took with the TRS as typical and common what they would do to any other third-party tenant. So this raises the issue of leakage. Should a TRS show at least some profit each year, or can a TRS show losses consistently? A lot of practitioners adopt the rule of thumb that a TRS should show at least a 3% profit based on its gross revenues each year. The problem with this is that if it's an artificial 3% and the numbers are massaged to get here, the IRS will look at that and think that the numbers do not reflect the actual economic operations of the TRS. So business is business, and whatever the TRS does on its own accord, should be reflected in its net income numbers. Finally, there's an issue with the potential application in Section 857B7. 100% excise tax is imposed on a REIT on any, quote, redetermined deductions between TRS and the REIT. In other words, if you load up the TRS with rent that's too high, thereby making its net income low or even negative, the REIT takes all this rent income into account, declares a dividends paid deduction, so there's no tax at its level. There could be 100% excise tax imposed on the REIT. The way to support this is to get a transfer pricing study to establish that the TRS rents are at arm's length. Transfer pricing experts are now well versed in the fact that this RDA lease structure is applicable really only to REITs and TRSs, and should be able to find enough comparables to support, the amount of rent paid. I see we have another polling question, Sean.
Thanks, Don. So the fourth polling question of the webinar is up on your screen, and it reads, independent living facilities do not qualify as healthcare facilities. True or false? Please make your selection now and be sure to click the submit button to get credit for your answer. Okay, just a few more seconds. Be sure to click submit. Okay, let's take a look at the results. Almost split down the middle, but 50.8% of the audience is false.
Right, this is split down the middle. So yes, independent living facilities do not qualify as health care. The correct answer is true. There are not enough medical services offered at the independent living facilities. I'll now turn it over to Bonnie, who will discuss infrastructure REITs.
Actually, I think, Craig, we ran out of time, unfortunately, so I think we're going to close out. I'm going to pass it to Craig.
Great. Thanks, Bonnie. So the remaining topics are infrastructure and looking forward. I mean, those both are related, and I think we're at the point with competing tax proposals between the House, the Senate, and the President that we need to wait to see what transpires over the next 2 to 3 months and see what provisions will be designed for infrastructure as well as what will be in the tax law. So those will be part of an upcoming webinar once we have more definitive information. So I wanted to thank everybody for joining us, and the materials are all there for you to review, and feel free for any questions. And please join us for webinar number 4, which will be on November 3rd at 12 o'clock. So thank you once again. Have a good day.
Thanks, Craig. We hope everyone enjoyed today's webinar. Thank you once again to all of our speakers. If you've completed the CPE requirements, your certificate is now available for download. You'll see the instructions on the screen now. If you're a Mazars employee, no need to download the certificate. We also encourage you to tell us what you thought about today's webinar by completing our feedback form, the link to which you will see on your screen shortly. Please take a minute and click that link once we conclude here. We hope you will join us for our next webinar in this series on November 3rd. Please click on the button on the right-hand side of your screen to register now. Feel free to reach out to any of today's presenters or myself with any further questions. Thank you once again and enjoy the rest of your day. Stay well, everyone.